Hi, I'm Steve Monticelli, and welcome to the What the Hemp podcast series, where we cover pertinent topics on cannabis taxation and that applying to hemp as well. So, as everyone knows at this point, President Trump has signed an executive order on December 18th, basically authorizing and directing the Department of Justice to reschedule cannabis to a Schedule III substance, which has got very large tax implications for our cannabis taxpayers who have been subject to 280E for too long at this point. And I'm joined with Ray Owens. Ray, welcome. And why don't you give us a broad brush of what the existing structure looks like before rescheduling, because we're not rescheduled until we're rescheduled. So what are you typically seeing for choices of entity for cannabis operators?
Hey, Steve. Thanks for having me today. I'm really happy to be here and talk about this. I think the industry has a really exciting year ahead of it. I know a lot of us came up working primarily on partnerships, but because of the sting of 2E, most cannabis companies at this point have elected to be taxed as C Corps. And so I think there's a lot of people out there who are laying in bed at night thinking, what's the future going to hold? Do I want to stay in this C Corp? Is there a double tax issue? Kind of exit strategy do I have? Is there a way to get back to a partnership, or should I consider an S Corp route? And as you know, a lot of cannabis companies avoided the S Corps for years. Maybe now there's a future in that. So I'm really happy to sit here and discuss with you. What are your thoughts?
It's interesting, pointed out, we have cannabis clients really have chosen two choices of entity, and typically partnerships and C corporations, and they both have their pros and cons. And, historically, at the very beginning, when someone's making this decision, it's important to understand a number of factors. And I think one of the important factors is, what is an exit most likely going to look like? Are we going to be selling stock? Are we going to be selling assets? And there is a difference relative to the tax outcome of selling stock and selling assets for both partnerships and C corporations. There's a tax rate differential. And as Ray pointed out earlier, many of these companies have migrated from partnerships or LLCs to C corporations for taxation. And one of the reasons is there is a tax rate differential currently. The Tax Cuts and Jobs Act basically provided for a flat C corporation rate of 21%, whereas before we had graduated rates before then. And 21% certainly is a low tax rate. The lowest a non-cannabis company that is a flow-through entity, either a partnership, an LLC taxed as a partnership, or an S corporation, can possibly get down to on a rate is 29.6. Well, Section 280E tries to provide some relief to the maximum individual tax rate for flow-through entity investors and owners, that basically says, okay, you're not going to be at 37%. We're going to provide you some relief. The lowest you can get down to is 29.6 on a flow.
But most of our clients didn't even get to that, right? Because with the QBI, and we'll talk about that more on a subsequent podcast about partnerships, but the wages, 280E would have restricted the wages, and the tax court came out and said that that was okay.
Exactly. And so all in all, it seems like the lowest we ever saw anyone come down to in cannabis was about a 32% rate. So you got 32% versus 21. Forget the states for a minute. The tax rate's about a third higher for a flow-through entity. And Ray, why would you opt for that in some cases?
So historically, you wouldn't, right? So when 280E came in and you weren't able to get any of these SG&A costs, you're effectively looking at like a 70% effective tax rate because you're getting taxed on gross profit. I mean, we all know that. We've all sat through the 280E seminars, right? So everybody migrated away from partnerships, but as we talked about at the time with a lot of clients, there's double tax on corporations. They may have dropped the rate to 21%, but to try and get that money out, you're either taking it out as compensation, either W-2 or 1099, or you got to then pay a dividend. And if you're lucky, it's qualified. If you're unlucky, it's not qualified, and that's a very high tax rate. So now, a lot of people are probably going to be asking themselves, is an exit immediate? Am I stuck in this? Is there a way to get back to that partnership? That's going to be taxable to get back to the partnership, right? And then the other thing is, are they eligible for qualified small business stock exemptions? Which, as you know, the most recent tax law changed. So I think there's some very interesting conversations to be had here. I'm not sure if there's a one-size-fits-all answer. I think, to your point, it really depends. Is this your passion? Are you in this to operate and make money? Or are you trying to get out? And if you're trying to get out, what do you want out of the deal? You want cash? You want stock in a publicly traded company? What might that look like? And I don't know. A lot of my clients are currently smaller. I haven't had a lot of questions recently about public exits. Have you?
Well, it's interesting. We have a lot of clients that really look for the qualified small business stock exemption. And basically, if you're an investor in a C corporation that's an initial investor, if you have held the stock for more than 5 years, you have a certain exclusion of gain up to 100% within certain limits. And in addition to the rate differential being less to operate, in addition to the fact that the investors don't have to deal with K1s, because cannabis has been interesting. There's a cash flow problem, if no one's noticed, with 280E, and many times the operating agreement calls for tax distributions to be paid. And then you find a situation where management's struggling on April 15th or March 15th to make a tax distribution to satisfy the requirement in the operating agreement because the cannabis company has been drained of cash with 280E. They don't have the cash to pay the distributions to the investors. So the C corporation structure is really nice because it gives you a possible exclusion of gain if you sell stock, if you hold it 5 years. It gives you no K1s because the tax will be imposed at the entity level. It gives you the opportunity not to worry about the tax crunch from management having to pay distributions to its investors because they got a K1 with phantom income on it. So I really like the C corporation structure, but it's very inflexible. So one of the downsides is if you pay a dividend, you have to pay it with after-tax dollars in the C corporation. And then the recipient of the dividend, chances are, will have a qualified dividend income experience. So there's a double level taxation at the C corporation level. That being said, I think, there are benefits to being a partnership. There's a single level taxation experience. And if it's a smaller entity rather than a larger entity, more likely than not, when you look at an exit, it typically is in the form of an asset sale. And an asset sale in a partnership is going to be taxed once, not twice. So the qualified small business exclusion really is only applicable for the sale of stock. And if you are a qualifying original investor that have held it for 5 years, and there are upward limits. So in the interim, while we're waiting for rescheduling to occur, what are we suggesting? What are we suggesting that people do? There are a lot of things you can do once rescheduling occurs, but if you're a manager of an LLC taxed as a partnership and you're looking to explore a potential C corporation structure for whatever reason, there are things to look at before just pulling the trigger, and more likely than not, we can incur a situation where there's no tax on that conversion. As a corollary, if we are currently a C corporation, as Ray pointed out just now, and you want to convert to a partnership structure because you want that single level taxation, you want the ability to pay distributions without a double level tax, it's a little tricky because, as Ray pointed out, it's a taxable event. So if your company is worth let's say the valuation's $10 million and the basis of the assets inside the company is $4 million, you've got a $6 million gain to convert it to a partnership. Well, in all fairness, when you've got that set of facts, more likely than not, you're not going to execute that and trigger that taxable event. It wouldn't be a wise move for
Right.
shareholder value.
Right.
So there are things to consider. Ray, what about timing on any of this?
That's what I was going to ask you. So I'm getting a lot of frantic emails. There's a lot of exclamation points. People are trying to figure out when they have to make their next move. And I mean, like you said, 280E, nothing's technically happened yet. We haven't rescheduled cannabis. We simply have an executive order saying that I think you guys need to put your foot on the gas. It says a couple other things too. There's some language in there about hemp. There's some language in there about CBD. It's actually very positive language about CBD, really looking at it from the medicinal side, which I think should be commended. But how are you talking to your clients right now about timing? Because we don't know when 280E is going to actually be rescheduled. Do we have to make elections before the end of the year if we want to go forward or back, or we want to try and go to an S corp? What kind of timing are you talking about with your clients?
It's interesting because hindsight's always 20/20, and I think any rash moves ahead of rescheduling certainly could be looked at in hindsight as saying, well, we should have just waited until rescheduling occurred. Unless you've got a set of facts that is unique, that you really want to go, let's say, from a corporation to a partnership, and the value accretion isn't there relative to the basis of your assets, whereby you wouldn't have much of a taxable event, if any at all, that may be a window. When rescheduling occurs, when you look at the public company valuations right now, they are materially above where they were before December 18th, when Donald Trump issued the executive order. So chances are when this changes, cash flow changes for these entities. And if cash flow changes for the entities, the valuations will certainly change. But I think the smart money in the interim stays put until certain things occur in the future in terms of knowing timing, and anything in the interim that you do, you've really got to think long and hard as to whether or not it will come back and cause any regrets in terms of decisions, because many of these decisions are not reversible without tax consequence.
Okay. So if I'm reading between the tea leaves and what you just said, right? So we're thinking there's going to be a lot more cash available. We're thinking that there's going to be a lower interest rate, which you didn't mention, but if we take this outside of cannabis and look at what's happened with the Fed recently, we're looking at lower interest rates. Do you think perhaps some of the clients that you have and future clients that you may have should be making some of these moves thinking that they're going to be acquired? Is there an anticipated uptick in M&A coming?
I would say yes to the question, but with every M&A decision comes the need for liquidity. It's challenging right now. There is capital out there. I know Vireo has done some deals recently, but there is not a lot of capital floating in the markets right now. If you're of the size to get attention with some of the larger lenders in the space, then yes, you've got access to capital. The medium or smaller size, I think it's somewhat challenging to really get M&A to ramp up. There have been a lot of exits of companies, of mid-sized to large-sized companies, to ESOPs, which makes a lot of sense from a tax planning perspective. Talk about mitigating 280E and taxation in general, but certainly that does have its downsides and limitations as well. I do like the idea of giving value to the employees instead of to the Internal Revenue Service. There's no question. So that's something that we continue to explore with our clients, but it has been a pretty robust planning idea over the last few years, and we've seen quite a bit of activity in cannabis companies in that space. But that being said, I think we're coming up on time, and we would love to chat with you. If you have any questions that are specific to your needs, please reach out to Ray, myself, and we'd like to thank you very much for joining us today.
Thanks for having me.